Yeah, welcome to my last lecture of the course, Research in Financial Markets. So before I start today with the lecture content, last year one of my master students who was in my master thesis group, his name is Topi, Topi Hutta-Halkola, and he had the idea to write his master thesis about combining value and momentum using the Nordic equity market. And he did a quite good job, I would say, a great job actually. And we had a couple of meetings about his paper or about his master thesis project. And he was combining basically one more recent paper, one methodology from a 2016 paper, and some parts of what I did here in the lecture about value and momentum, and he was elaborating on that, basically merging some ideas from different current, very recent papers published in the finance literature. So, and I would have given him a 4 anyways for his thesis, maybe even a 5, but in our last meeting, we had a discussion, and I gave him some suggestions how he can improve his thesis, even though it was already great. It was already great. He did a great job, and a very smart guy, by the way. And he was willing to go the extra mile and to write even better thesis. He did a great motivation. I think the key point was in this case that I would like to see a very good motivation for why he would use the Nordic stocks. I told you already in an earlier lecture that once you deviate from the US equity market, you have to have good reasons for why you do what you do. Why would you pay attention to other equity markets? So there must be a reason for that, a very good motivation for that. And this is also what he came up with a very good motivation in his paper and in his thesis. This is now the paper version of his thesis. I rewrote it as a paper. So in section 2, he is basically writing about for why the Nordic equity market is worthwhile considering and investigating. And he had great points. I have not expected that he would come up with this excellent explanation for that. And it made sense for me, a lot of sense. And so we decided that we would give it a try and to rewrite his master thesis as a paper. And we submitted the paper. I submitted this paper to a journal a couple of months ago. And on Monday evening, I got the message that the paper was accepted for publication in a quite good journal with impact factor. So this is the second master thesis. I'm here since about four years now. And I've read about, 25 master thesis, and 2 out of 25 have been published in a scientific journal. So it's a great job for a master student who can basically deliver the same quality of work than we do here as finance doctors. And I think it's a great thing also for him in a CV, because there are many people who graduate with 5. Quite many more than you might expect get 5 for the thesis, but only very few people they have actually a published paper in the CV. So that's a great thing. And of course, because he was willing to go the extra mile and so on and so forth, of course I told him that I will go to Helsinki in 2 weeks, and then I will of course invite him for dinner, and probably we will get slightly drunk. But this is of course very positive, and I'm very happy for this. I'm pretty excited whenever I see that students can deliver like this kind of quality work. It's a pleasure to read and a pleasure to see, and I know that there are some very smart people here, and once you are willing to go the extra mile, you get a payoff for that. Of course, it must be like that. So there must be a payoff for hard work and for doing smart things. So, of course, my other master student whose thesis got published, he got even this 5,000 euro tax-free Best Thesis Award, and I'm betting that Topi will also get this award, or at least he has a very good chance to get the Best Paper Award. So it's not always going to Aalto students. Yeah? Our students get the Best Paper Award as well nowadays. That's good news, I think. So then another thing, I get some emails from time to time, or actually quite regularly. Every term I get the same email. So a student asking me, yeah, you know, I've seen that you're giving this quantitative finance course in a couple of weeks, and I would like to take the course as well, but I'm working full time. Can I still take the course? I get this question every single year. Every single year, the same question. So, first of all, I would like to refer to the student guide on page 22. There is the job description of what it means to be a student. What are your responsibilities? So it's, for instance, preparing for lectures, attending to lectures, making lecture notes, learning the course content, doing the exercises, taking exams. That's the basic job description for being a student. Yeah, that's nothing weird. It should be pretty obvious, yeah, that this is what you are supposed to do. And that's not an online course. It's not an online lecture either. And it makes sense that you come here as well, because we have a conversation. This is actually what we have. We have a conversation here. So if I'm talking about something and I can see that some of you have difficulties to understand, and I can see that. Yeah? I can see if people get defensive and so on and so forth, and then I have to take maybe a different viewpoint, or I have to explain once again. So it's a conversation. Who of you has read the book from John Patterson, 12 Rules for Life? No one. Okay. Maybe you should put it on your wish list as a Christmas present. Well, the guy is he is clinical psychologist and is professor for psychology at the University of Toronto, and he has written a book. It came out this year, a couple of months ago. It's already a bestseller. He comes also to Helsinki very soon and gives a speech about his book. And well, the guy has an IQ of 150 plus, yeah? And you know there are not many people who are there, obviously. So, and my humble opinion is, I mean, whenever someone who is that smart has something to tell you, maybe you should listen. Yeah? Maybe it could benefit you. Yeah? So that's at least what I do. So I read the book and I saw about 100 hours of lectures that he put online. Very interesting. You can learn a lot. And the thing is, you know, if you are not here, it doesn't have much of a sense that I'm teaching here anything. So it's important that there's an audience that gives me somehow a response for what I do. So then I can see if I, you know, explain things in a reasonable manner, or if I have to elaborate on certain issues. So it's very important to get like this feedback. I mean, of course, it's obvious that I cannot talk with everybody personally, but I can see if you get it or if there are question marks. So I can see that, and actually a good lecturer should see that. Okay, so a good lecture is more a conversation actually, and this is also what it says in the book once you have read it. So, and then if a student is coming, and you know, the first impression matters. It's if you go to a job interview, or if you have a date, it's always the first impression that matters. And that will be deciding for your progress afterwards, whatever it is about. But what do you think, what do I think if I get this kind of email, you know, about the student who, in my opinion, does not really want to take the responsibility because he or she wants to work full-time? Do you think that I have the impression that she or he respects what I do? No, of course not. So the answer is, yeah, you can take the course, for sure. because no one can force you to participate in the lecture, but the question is if it doesn't make so much sense then for you, because usually people who do not attend the lectures, they have a lack of understanding these issues, because there's a congruent story. All these papers, this is not random. There's a reason for why I have the structure here, for why I do what I do here. There's a red line through it, and so this is not random. And I elaborate on these things in the lecture, and every year I teach that. I pay attention to different things, and of course every exam is different, depending on what I do here. So of course you can, you don't have to come here. No one forces you, but I mean you have to make a choice at some point. Either you're a student or you're an employee. If you're a student, you work 50 hours at least a week. If you want to be a good student, If you don't want to be a good student, then it doesn't make much of a sense. Okay, then you can easily do other stuff. So you have to make a choice, and it's up to you if you choose to work or if you choose to study. But you cannot do everything at the same time. Yeah, that's my thought to these kind of emails that I get. Just that you know. So, and I'm always willing to answer additional questions. Either here after the lecture, or otherwise you can always book a time. And then I don't have like official office hours, but you can always book a time, and then we go through what you want to know, and then we can, discuss everything. So that's no big deal. That's my job. But it's not my job to write like 120 emails per day. That's not a part of my job description. So I'm willing to have discussions with everybody, face to face. But I do not reply, or I do not want to write hundreds of emails every day, because it just takes my time, and things go easily wrong if you just write an email. Things get easily wrong, so that's why it doesn't make much of a sense. All right. Today's lecture, we go through the last paper here. It's again from Fama in French. And there's a reason for why I chose two papers of Fama in French. I told you that Eugene Fama won the Nobel Prize in economics, so when he has to say something, it's perhaps pretty important for us to know. And in this paper here, basically what he's doing, he is basically expanding, or they are extending the results of their earlier paper. The earlier paper was focused on the US equity market. Yeah. But just because something might work out in the US doesn't necessarily imply that the same driving forces or the same model might also explain something on other stock markets. So there's a paper from 2008 from Fama in French dissecting anomalies, and in their paper basically they highlight that it is important to take, that every result you have in financial markets can be sample specific. So once you want to do anything that has already been done for the US and you want to do it in another equity market, it might make sense to cite this paper, that you basically that you want to test whether the results are also valid in a different sample. Yeah, so it makes sense to cite this paper from 2008 once you want to do financial research in a market other than the US. Yeah, so in the paper, they investigate the European market, they investigate the Asian market, the North American market, which basically means USA and Canada, and then they have Japan, always as a separate market, which also makes sense, what we will see later on here. So on this page, on the first page, you see the asset pricing model that they use for testing the assets or the equities, and it's the same model that we have already seen. Yeah, it's the same. That's nothing new. It's the same model like in the 2015 paper. Yeah, market factor in excess form here. We have the size factor SMB. We have the value factor HML. We have the profitability factor RMW, and the investment factor conservative minus aggressive. And of course, because it's a regression model, we have here also the error term. Yeah? So they write here, we take the perspective of a US investor and measure all returns in dollars. What's the problem with this approach? You might wonder. So the problem with this approach is that you have always basically the dollar factor somehow in the data. Yeah? If you transform euro to dollar, you have to multiply basically the index with the exchange rate, which is basically the dollar factor. Or basically, but yeah, you have always this dollar in the data. So the results can be most likely be driven by how the dollar has evolved over time, if it has depreciated or appreciated. That's one thing that I would see here in this paper as an issue. And again, we said already, we talked about it many times, in an asset pricing test, we are investigating if the intercept here is 0. Because once the model is basically describing the cross-section of expected returns, we would assume that there are no systematic pricing errors. And this is exactly what alpha here is capturing. Alpha captures the systematic part of the error here, of this E, of the error term. And once this is significantly different from 0, we know that these regressors here, our asset pricing factors, cannot explain the whole evolution of this return here, of the asset return, Ri minus Rf, which is the asset return in excess form, because we subtract the risk-free rate. Moreover, they also introduce a global asset pricing model where they construct global factors, global size factor, global profitability factor, global investment factor, and global value factor. And what they basically conclude is that market integration has not developed that far that the global asset pricing model can actually price test assets, global test assets, globally sorted test assets. But they have also local versions, local for Asia, local for Japan, local for Europe, and this asset pricing model work relatively well, depending on the country though. The difference to the 2015 paper, what they highlight here on page 443, is that the investment factor, that their tests suggest that the investment factor is on a shaky ground. We remember from last session, from last lecture, that it was actually the value factor that was redundant. But here in this paper, they argue that it's the investment factor. Then in section 2.2 on page 443, they are writing about the portfolio sorts and so on and so forth. We were talking about it last time already, so that's not our key interest here in this paper. Yeah. So on page 444, on the next page, they are exactly talking about what I already told you, that global factors do not span the regional factors. So we have to use the regional, the local factors if you want to work with this 5-factor model. Yeah. So the first interesting table is table 1. And in table 1, they report the sample averages of the risk factors for each of these 4 markets that they consider. For instance, in panel A of table 1, on the left-hand side, we see the results for North America. Now you have to think, okay, North America, USA plus Canada. And we see here in the first row where it says mean, we see the sample average over the sample from 1990 to 2015. We have now 306 months in our sample. We remember the paper from 2015. We have 606 observations, so almost twice as much observations we had available. Now it's only half of the observations. Why, you might wonder? because some of these stocks here in Europe and in Asia Pacific, they were not available before 1990. So, and in order to make the results somehow comparable, of course, then we have to restrict the whole sample to 1990. So that's why we also consider the North American stocks over this sample period only in this paper. So what we see is the market factor, for instance, in panel A in North America has a sample average of 0.62% per month with a t-statistic of 2.53. Now we have to remember again the normal distribution. We have our critical values of 1.96 on the right-hand side and minus 1.96 on the left tail. And our t-statistic always suggests in the null hypothesis that the point estimate would be 0. So 0.62, it's somewhere here. It falls in the critical zone here. And it suggests that the market factor generated returns of 0.62 per month, and this payoff is statistically significant on a 5% level, given the sample period. So then, in the next column, we have the S&P factor for North America. Point estimate is 0.17% per month, but the t-statistic is 1.05, which suggests that this payoff is not significant. So there is no such size effect in this sample period for North America. We don't have a size effect. This is what it tells us. Next column, we have the HML factor, the value factor. Point estimate, 0.20% per month. That's not much, right? T-statistic is 1.08. It's like the size factor. Under the null hypothesis, the point estimate is not different from 0. We cannot reject the null hypothesis. The point estimate is somewhere here. It's within this 95% probability space. So obviously, there is no value effect either in the sample period in the North American market. But now we are talking the profitability factor, RMW. Given the sample period and given our North American sample, payoff is 0.34% per month, and the t-statistic is 2.46, suggesting that the profitability factor indeed paid off. The sample average was significant, implying that stocks that were profitable outperformed those stocks that were unprofitable in North America, given the sample period. Then we have the CMA factor here for the US and Canada. The sample average is 0.29, t-statistic is 1.86. Given we have a 5% significance level, we cannot reject the null hypothesis that the investment factor did not generate any excess returns given the sample, which is a contradictory result, obviously, to the 2015 paper, where we figured out that the investment factor was highly significant, right? So, and then we can move on. We see here on table 1, on the right-hand side, we have the point estimates for those 5 factors for the European market. We can go through it here. What we see is that the value factor and the profitability factor, these were the only factors whose payoffs were statistically significant on the 5% level given the sample period. The other factors, even the market factor here, didn't pay off any significant average returns in the sample period. In the lower part of panel A in table 1, we see the result for Japan. Here, nothing seems to be profitable. I mean, only the HML factor, the value factor, with the point estimate of 0.36, is statistically significant on a 5% level, as the t-statistic is 2.19. All the other factors don't really matter here, obviously. In Asia Pacific, things are a little bit different here. So the market factor is significant, obviously. The value factor and the investment factor also seem to be significant, whereas the profitability factor and the size factor do not generate any significant payoffs. And now you may wonder, okay, why is that? Why is the result deviating? There are many explanations for that, and we will go through it step by step. One explanation is basically provided implicit in panel B of table 1. Now they grab these 3 important factors. I say important factors because these are the factors that we actually derived last time from this valuation model, and it's the value factor, the profitability factor, and the investment factor here. Yeah. So the first 3 columns of panel B in table 1, we see in the upper part that they split the value factor, into a universe just considering small stocks, and also in the universe just considering big stocks. Yeah, which you see here. In the first column, they report the point estimate, which is 0.41 for small stocks in North America, with a t-statistic of 1.78, and for big stocks, which has a point estimate of minus 0.01 and a t-statistic of minus 0.07. Now they do something similar what we did in this investor sentiment paper. You might remember, in the investor sentiment paper, we were taking the return difference between high and low investor sentiment. And here they take the return difference between small and big stocks, but they use the same factor. And what they figure out here is that the point estimate, which is 0.43, with the t-statistic of 2.44 for North American stocks, it seems to be that this value factor is driven by the return difference in small minus big stocks. And you see this also for all the other factors here, or for the other markets and the other factors. You'll see the same patterns here, apart from Japan. Japan is an outlier here, but for Europe, Asia Pacific, and North America, we see the same patterns here. Once we break down every factor into small and big stocks, and then take the return difference between small and big factor I, we see that the return difference seems to be significant, implying it's somehow related to small stocks. And this is also what I told you already many times, that any asset pricing phenomenon is more pronounced when we implement the strategy among small stocks. This is what we see obviously, very obvious here. Then in panel C of table 1, we see the correlation matrices for the factors, but across regions. Interesting, I find the RMW, so the profitability factor. If you have a look at that, the correlation matrix implies that the correlation of the profitability factor across our 4 regions, North America, Europe, Japan, and Asia Pacific, seems to be pretty much uncorrelated. The correlation is very low. It's virtually 0. What does it mean? What does it imply? Let's assume you are a fund manager and you want to run a strategy for your customers, and your selling point is, okay, we invest in stocks that are just profitable. A global mutual fund that invests in profitable stocks. Would it make sense? If you see the correlation matrix here. We know from undergraduate studies that as the more assets we have in our portfolio, the less is the portfolio risk, the overall portfolio risk, right? But I told you already in the second lecture that if the covariance between our assets that we invest in is increasing, it could be that we don't have any benefits from diversification if the correlation is very high. Yeah? But in this case, there is a lack of correlation. The correlation is virtually 0. So if we would implement this profitability strategy in a global equity market setting, we could nicely invest in the profitability strategy and invest across these countries here, estimate the local factors as local strategies, and take the average, basically divide our invested amount of money into these 4 markets, 25% in each market, and then we would have a well-diversified portfolio with low risk. right? It would be even better if there would be negative correlation going on, like in the value, like in the example with the value factor and the momentum factor. But zero correlation is already quite good. Yeah? So this would be a nice strategy for an investment fund, for instance, if you think practically now, okay? Because we are interested in money, right? Okay, let's move on. What they also highlight in their paper, I mean, of course, somehow you have to sell your paper, or you have to sell your research. And of course, I mean, we have figured out already in the 2015 paper that, the problematic stocks are those companies basically that have a high asset growth, so that invest a lot, but that are not profitable and small. So small companies that are unprofitable but invest a lot. These are the firms that cause problems for our pricing model here. And now they argue, of course, yeah, well, let's see if this is also true for all the other markets. So that's basically one motivation for why they set up their paper. In table 2, that's now the next interesting table for us. They basically replicate the same thing that they did already in the 2015 paper. In panel A, they report portfolios sorted by size in 5 size groups and book-to-market ratio, from low to high book-to-market ratio, 25 portfolios. But now for North America, so we include also the stock from Canada in the sample. And we see that for portfolio group 3, if we are in book-to-market ratio group 3, 4, and 5, we see that the average return increases as we move from big to small stocks. So there's a size effect for these groups. This is what we would expect. We would expect that small stocks generate higher returns than big stocks, according to empirical evidence reported in earlier research, right? But if we see group 1 and group 2, that's not true here. Again, there's something strange going on here in our group, or in our group of stocks that have a low book-to-market ratio, which are in essence growth stocks. Then we see on the right-hand side of panel A, we see the same for European stocks. Again, 25 portfolios sorted by size and book-to-market ratio. And we see a similar pattern here. Actually, only the 5th group, so value stocks, only if we have value stocks, we see a spread as we move from big to small stocks. Only in the value group, we see actually this pattern that we would expect, namely that small stocks would generate higher returns than big stocks. But all the other groups here do not show this pattern. Then we can see here in Japan, there's completely weird going on here. There's nothing in line with what you would expect. So Japan is usually an outlier when it comes to equity markets. It's somehow different than other markets. There are also some theories actually for why this is so. If you are interested in that, there's a whole bunch of literature that is talking about that. Then we have Asia Pacific as our final sample here. Again, 25 portfolios sorted by size and book-to-market ratio. And here we see for group 3, 4, and 5, for our book-to-market ratio group 3, 4, and 5, we see there's a spread as we move from big to small stocks. So small stocks tend to generate higher returns than big stocks, at least for book-to-market ratio group 3, 4, and 5. Whereas we do not see that pattern for group 1 and 2, where we find the growth stocks. So that's a little bit problematic, and some of these results we might not have expected. In the lower part of panel A, we see now the same. They do the same again for portfolios. Now again, they take the whole universe of stocks. First for North America, divide the whole universe of stocks into 25 groups depending on size and book-to-market and operating profitability. And they do that for all our 4 regions here, for North America, Europe, Japan, Asia Pacific. And what we see here is that once we sort with respect to operating profitability, instead of book-to-market ratio and size, we see that we have this pattern again that we also would like to see. Yeah? That in each group of our profitability sorted quintiles, yeah, we see a spread as we move from big to small stocks. So small stocks tend to generate higher returns than big stocks in every of these quintiles. Yeah? And then again, and finally, they do the same and sort with respect to size and investment, yeah? Where they divide the whole stock universe into 5 groups, from low asset growth or low investment stocks into high investment stocks, and then they break it down into 5 size groups. And then they report the average returns again, which you can see here. So it's basically the same thing that they already did in their 2015 paper, but now extended to more markets. Yeah. On table 3, they do again these factor regressions that we already have seen in their 2015 paper, but now they report the factor regressions for all the markets. Yeah. Here in the upper part of table 3, they report the factor regressions for North America. So what they do is, again, like in the 2015 paper, first they use the market factor and they regress the market factor on the size, value factor, profitability factor, and investment factor. On the right-hand side of table 3, they report the corresponding t statistics against these factor loadings, as well as the R-squared. And what we see is, after we regress the market factor, so the excess market returns on these 4 factors here, the intercept is 0.99, so it is roughly 1% per month, with a t statistic of 4.7, which indicates it's highly significant. Yeah. So the average payoff of the market factor after risk adjustment is about 1% per month, given the sample period from 1990 to 2015. So it would be a good deal. You would have earned risk-adjusted market returns of about 12% per year, covering 25 years, which is a nice payoff, right? Then next, they do the same for the size factor. And the interesting thing is the HML factor here, the value factor. Yeah, we remember now from the paper that we discussed on Monday for the US, only the US market, we remember that once we did the factor regressions in this one table, yeah, that we went through, that after you regress the HML factor, the value factor, on the other risk factors, we remember the point estimate against the investment factor was 1.04, I guess, right? T-statistic of something like 20. Yeah? And we remember that the intercept indicated that it's statistically not different from 0 after we regress it on the other risk factors. That's why they argued in their 2015 paper that the value factor is redundant after we control for investment. Yeah? Because the correlation between value and the investment factor was 0.7 in the US for the sample period from 63 to 2015. Now the sample period is different. Yeah? We have now 25 years of data from 1990 to 2015. And after risk adjustment, so after we regress the value factor on the market factor, size factor, profitability factor, and the investment factor, we see that the risk-adjusted intercept term is now negative. It's minus 0.28. First of all, it's negative. And second, I mean, it wouldn't be so dangerous, or it wouldn't be so fancy if the t-statistic would indicate that this payoff is statistically 0. Yeah? Because just just considering the point estimate of a parameter doesn't say us anything. So we have to always look at the t-statistic. So what is the t-statistic telling us? In the same row, now we move to the right-hand side of table 3. We see the point estimate has a t-statistic of minus 2.44, which indicates this minus 0.28% per month is statistically significantly negative. So the value factor generated negative returns, significant negative returns. So if you would have run the value strategy, given the sample period, you would have had huge losses, right? Is this clear to everybody? That's a huge difference between the paper from 2015 and this paper here. And I remember once I asked actually this question in the exam. Yeah. So you have to compare these two tables with each other, the point estimates, and then you have to come up with a story for why this is so. Then we can also consider Europe, what's going on in Europe, and in Japan. So in every country, there's somehow different patterns. So there's no coherent story what's going on here. You know. Interesting in the European market is the CMA factor, the investment factor. So after risk adjustment, after you regress the investment factor on the market factor, size factor, value factor, and profitability factor, the risk-adjusted return is 0.09, yeah, the intercept, and the t-statistic of 1.08 suggests that the payoff is statistically not different from 0. So this is also what they wrote in the beginning of the paper, that it seems to be that the investment factor is on shaky grounds here. Yeah. See the same pattern here in Japan. Yeah. After risk adjustment, the investment factor, the payoffs are statistically not different from 0. But in Asia Pacific it is. After you regress the CMA, the investment factor, on the other risk factors, which you see in the last row of that panel, the t-statistic is 2.36, which suggests that the investment factor, given the sample period in Asia Pacific, indeed generated excess returns. So on table 4, they again replicate one of the tables that they also use in the 5-factor model paper for the US market. So what you see is they report the GRS statistics for different test portfolios. Yeah. So again, they use first 25 test portfolios sorted by size and book-to-market ratio. And they report the results for the US. And you see here in the upper part, in the first row of panel A on table 4, they used first the 3-factor model as a reference model, exactly like in the other paper. So the GRS test has a test statistic, or the estimated test statistic is 2.85. And you see in the second column is the p-value of this test statistic, and it is 0.00. Yeah. So in the third row, you see the 5-factor model, which on the left-hand side you see the regressor set, and then you see in the GRS column you see the point estimate of the test statistic, which is 2.34 for the 5-factor model, and the GRS test is 0.00. What does it tell you?
Market SMB, HML, and RM.
Yeah.
Why didn't they have also send the 3-factor plus CMA instead of the air?
Yeah, one might wonder that, right? I don't know. I was wondering the same. Maybe there was no difference. Maybe there was no reason to report that. Okay. Probably. Yeah. So what does the test statistic tell you? What is the GS test doing? What are we testing? I told you today we will talk a little bit about the GRS test. So under the null hypothesis, we have 25 test assets, and we are interested in the alpha, okay? So under the null hypothesis, we test whether the alphas are jointly 0. Yeah, that they are in this 95% probability interval. Whereas the alternative hypothesis is that we have to write it more precisely. At least 1 alpha E is unequal to 0 for I is running from 1 to 25. Now that's the alternative. So on the alternative hypothesis, if we reject the null hypothesis, then at least one of these pricing errors is statistically different from 0. Which implies that there's systematic mispricing going on and the model cannot explain the full cross-section of expected returns. So if you get this p-values here, well, what does it tell you? Did you learn in econometrics how to interpret p-values?
What p-values in the other side of that?
So I told you last time we can have two different test statistics. If you use an f-test or a chi-squared test, doesn't matter. It has positive values, right? And the p-value. So let's say we want to have a significance level of 5%. So that we have, for instance, our test statistic, and then we know the critical value is here. And once the test statistic indicates that it's larger than our critical value, then we know that we reject the null hypothesis. Which means in our case, okay, the model cannot price this test asset because one of these alphas seems to be significantly different from 0. So this is our 5%. So this critical value gives us 5% probability mass here on the right-hand side of the distribution. So if the p-value gives you the estimated probability mass of the test statistic on the right-hand side. So if the p-value is, for instance, 0.12, it means it falls here in. P is 0.12. So which is 12%. Because 12% is larger than 5%. In this case, we would not reject the null hypothesis. If the p-value is larger than our significance level of 5%, we would not reject the null hypothesis. And in this case, we would say, okay, the asset pricing model can price these test assets. But 0 means, okay, the test statistic is somewhere here. It's much smaller than 5%. Which means we reject the null hypothesis because our test statistic indicates, well, there is at least one alpha that is significantly different from 0. And last time I made a little error. I apologize for that. So the test, because I was reading it again when I was at home, the econometrics book, and of course the f-test that you use is distributed with 25 degrees of freedom, which is the number of restrictions, and you have 25 alphas, so you test 25 parameters. So you have 25 restrictions, so you have 25 degrees of freedom first. It's distributed as F distribution with 25 degrees of freedom and 306 minus 6 degrees of freedom. Because we have T observations, 306, and we have 6 regressors. We have five risk factors, and we have the intercept, which is 6 regressors. So we have to subtract them here. So the reference distribution under the null hypothesis is either the F distribution with 25 degrees of freedom because we have 25 parameters that we set equal, or that we test whether they're equal to 0 or not, and the sample size minus the number of regressors. So that's the correct reference distribution. And the point estimate for the 5%, but gives us a 5% probability mass here on the right-hand side, is 1.54. So we have basically to compare the point estimates here with 1.54. And whenever this guy here, the estimated GS test is larger than 1.54, it indicates that we have to reject the null hypothesis. Yeah? And this is exactly what happens here. But then let's move to Japan. So the test statistic is 1.4, which is here. So given we have a significance level of 5% in Japan, irrespective if we use the 3-factor model or the 5-factor model, all of the models here indicates that these pricing models can price the test assets in Japan. At least this 25 test assets sorted by size and book-to-market ratio. And the same is true actually if we go to the next test assets, if we check the 25 test portfolios sorted by size and operating profit, the p-values here are much larger than 5%. Yeah? All of these test assets here can seemingly price these test assets correctly. But is that really true? And now we have to think critically. That's why this is not an applied science school. Can you read from this table here? I mean, because once you know the information that we have already seen in the other tables, could you say that for Japan, the 5-factor model is well suited for pricing the cross-section of assets? If you would just see this test statistic here, you would say, well, yeah. But does it make any sense to you? If you think critically. I don't ask students, but if I ask students, I usually ask them in the last row. Yeah, or second last row. So don't be deceived, okay? Asset pricing tests and all these tests are nice and so on, but you have to think a little bit, okay, critically, what's actually going on here? So first of all, let's go back to the first or second to the second table. Here we have Japan. Here we have the sample averages of the risk factors, of the SMB, HML, profitability, and CMA, and the market factor in Japan. Those are basically 0. There's no risk premium here going on. So the HML factor seems to be the only factor that has a slightly significant payoff here, but all the others are statistically 0. So you regress something on the left-hand side, some test assets, on something that is 0 on average. That you then get a test in the GIS test, something like p-values above 5%. It's for me not very surprising. Okay. So you have to see this result in association with this table here. Yeah. The risk factors are basically 0. So it's not surprising that then the GRS test also indicates, well, these risk factors can seemingly price this test assets correctly, but actually they don't price anything at all. Yeah. It would be much more interesting if actually these risk factors would have been significant. Then we could have said something. For instance, in Europe, let's see panel C, 25 test portfolios sorted by size and investment. Yeah? And now we go to Europe. That's interesting, because we have seen in Europe and in table 2, we have seen that the payoffs of these risk factors are significant, most of them. So they explain something. They capture some sort of risk premium here. So, and what we see is when we use the 3-factor model, which we see in the first row here, panel C, the first row, and yeah, using the 3-factor model generates a GRS test of 1.91, which is somewhere here. So p-value is 0.01, so we reject the null hypothesis. So there's mispricing going on, implying that the 3-factor model cannot price European stocks sorted by size and investment portfolios. But then we move to the 5-factor model, which is in the reported in the last row. Yeah? And we see the GRS test drops from 1.91 to 1.02, which is now here somewhere. And the p-value is 0.45, larger than 5%, which implies using the 5-factor model, we can price European stocks sorted by size and investment. And this model is actually true, or it actually works out, because we have seen that the sample average of these risk factors is significantly different from 0. So they explain something. And here's Samayoto for Japan. And as we already said earlier, these p-values here actually don't tell us anything, because the risk factors are 0. And if you consider North America, and again, 25 test portfolios sorted by size and investment, p-values are 0 for all of these models, irrespective if we use the 5-factor model or the 3-factor model. The same is true for Asia Pacific. The p-values indicate that none of these models can price the test assets, the corresponding test assets for the market sorted by size and investment. I also had in one of the exams questions related to this table here. So, yeah. We will also see in the handout that I gave you, you can study the setup of the GRS test. I have it, where do I have it? Here. I call it seemingly unrated regression models. So we have a multivariate equation, we have a multivariate model and multiple equations. So in the handout that I uploaded on Moodle, you see how the model looks like, the whole model. And I will give you now just a very brief review, because we don't have so much time today. So what we can do is we can estimate this model equation by equation as well. So you can what you can do is either you build a huge model with a block matrix. Let's say we have a y1 vector, a y2 vector, and a y3 vector. And the dimension is 3 times t by 1. And we can of course estimate a model where we have x matrix here, then 0 matrices here, we have a 0 matrix here, x matrix here, 0 here, 0, 0 here, and x here. This is a block matrix. And each of these x matrices here, they contain of like a vector of ones, then a vector of market excess returns, then one vector of the S&P factor, one vector of the HML factor. If you consider now just a 3-factor model. And the zero matrices here have the same dimension. So, and then you get point estimates, you get beta estimates, you get the corresponding beta for the first excess return vector, which I denoted here as y1. We get the second one and the third one corresponding to this and this and this equation. And then we have also an error term here. It's easy to do that, of course, in MATLAB. But I mean, we can estimate it as a big model, as a block matrix model, but we can also estimate it equation by equation. Because the point estimates are the same. If we estimate the whole model and we get the parameter vectors, it's the same as if we would run each model equation by equation. So what we can do instead is we can regress the exact returns of the first asset on our regressor matrix here. So we get our first parameter vector that's denoted as beta y, and it's simply given by x transpose x inverted times the regressor matrix transpose times the y1 vector. So we can use, after we have estimated the point estimates for the first equation, so what we get is we can estimate the residuals, the estimated residuals for the first equation, which is a t by 1 vector, which stacks the residuals corresponding to our exact returns for the first asset into a column vector, which is t by 1. And we can do that for all the equations here. The only thing that changes here, because we use the same regressor matrix here, which is our asset pricing model, the only thing that changes are the exact returns that we use here on the right-hand side. So we get 25 of these estimated error vectors. And we can use these error vectors simply to compound the covariance matrix of these error terms here, which we need for our test statistic, roughly speaking. You see this in the handout on page 2. Here, this guy here. So we need the error vectors to estimate our covariance matrix. So the first guy here, for instance, we would simply compound the scalar product, this vector here times itself, divided by the number of observations, and then we would estimate the covariance between the error of the first asset and the error of the second asset by taking the error vector of the first asset times the estimated error vector of the second asset divided by number of observations, and so on and so forth. Then we get the covariance matrix sigma hat for our set of assets. It's pretty straightforward. I describe it here in detail. So it's a very easy to grab basically what's going on here. So I really get a pretty straightforward explanation. You can just go step by step. You will probably understand by yourself what's going on here. So the point is, or the crucial point to note is why we do that. So let's say we have 3 test assets. So we have three alphas, 3 pricing errors, right? 3 alphas that we test. So then there's the question, okay, what's the variance? Because in order to, when we estimate the test statistic, we need the variance or the standard deviation of our random variable. And the thing is, our point estimates, our parameters, like beta 1, beta 2, beta 3, but also the alpha is a random variable. It's random because our exact returns are random. So our point estimates, our alphas are also random. They are random variables. They are a linear combination of our y of our exact return vectors. So each estimated parameter is a random variable and has its own distribution. So what's the variance of, let's say, alpha 1 alpha 1 plus alpha 2 plus alpha 3? Because we need that to get our test statistic. So, well, it's the variance of alpha 1 plus the variance of alpha 2 plus the variance of alpha 3 plus 2 times the covariance between alpha 1 and alpha 2 plus 2 times the covariance of alpha 1 and alpha 3 plus 2 times the covariance of alpha 2 and alpha 3. So the covariants are also a part of the test statistics standard deviation or variance. So that's why we need the sigma here, the sigma matrix which is a part of our test statistic here, that basically grabs or gives us the corresponding correlations here between the alphas. Yeah. So that's roughly the idea for why we need to estimate this the correlation matrix of the errors here, because we need it later on for getting the covariance of the alphas that are random variable. But luckily, eViews is doing that for us, and we don't have to do it by hands. And in one of the exercises, we will then see how we can work with that in eViews. But that's just for you that you grab a little bit the idea for what's actually going on here. So in table 5, that is the next interesting table. They report the pricing errors, so the alpha estimates, yeah, from this equation here. They report only the intercepts, which is in essence our alphas, for the 25 test assets sorted by size and book-to-market ratio for North America and Europe. Here in the first part of table 5, we see the point estimates for North America. And what we see is, for instance, if you consider the growth stocks here, the quintile of growth stocks that are small in size group 2, we have a point estimate of minus 0.45% per month, so negative returns, minus 0.45, and the t statistic is reported on the right-hand side of panel 5, on table 5, and it says the t statistic of this pricing error here is minus 4.32. So, and we remember from previous lecture that Fama and French reported that the problem firms, or the firms that cause the most problems for the asset pricing model, are those firms that are small, that have a low profitability and high investment. So firms that invest aggressively, that are not profitable and small. And if you combine table 5 with appendix table A1, you will actually see the corresponding sensitivities of this portfolio here against the profitability factor and the investment factor. And what you will see is that this guy here, size group 2 and low book market ratio group, that it loads statistically significantly negative on the profitability factor and also on the investment factor, which implies that these stocks here, or these companies which are in this portfolio, are small, have a low book market ratio, invest aggressively, and are not profitable. So these are exactly the same kind of stocks that caused also problems here in this sample, and it's the same stocks that also cause problems in the Fama and French 5-factor in the original paper that we discussed on Monday. Same stocks, same companies. So what we also see here, that if you count again the number of significant t-statistics here, for the three-factor model, it's 5. And if we move down, for the five-factor model, it's 7. So it does even worse. The five-factor model prices even less stocks or less test portfolios properly compared to the three-factor model in North America. Whereas in Europe, it does a slightly better job, because in Europe, using the three-factor model, there are 3 portfolios out of 25 which cannot be priced by it. But using the five-factor model and European stocks, we see that only 2 out of 25 portfolios cannot be priced, since 2 out of 25 portfolios have t-statistics that are significantly different from 0. And if we go back again here to size group 2 and growth stocks, like low booked market ratio stocks, in the three-factor model, we have a point estimate of minus 0.45, as we already said. If we move now to the five-factor model, the point estimate, it's slightly improving to minus 0.27, but it's still statistically significantly different from 0. So it improves a little bit, but it's still not pricing it correctly. It's still causing problems. Now we can move to the other tables. In table 6, now they use test portfolios sorted by size and operating profit, again 25 groups. And what we see is, using North America, the three-factor model cannot price 11 out of 25 portfolios. So 11 guys, 11 point estimates reported in the left-hand side of table 6 are statistically significantly different from 0. But if we move to the five-factor intercepts here reported below, we see that the five-factor model can price 20 out of 25 portfolios. So the number of mispricings decreases from 11 to 5, which is a good performance. Yeah? And a similar thing we see in Europe, using European stocks, the three-factor model, which you see here on the left-hand side of table 6, and on the right-hand side you see again the corresponding t-statistics. We see that 13 out of 25 portfolios cannot be priced by the three-factor model, but if we use the five-factor model, which you see below, we see that only 8 portfolios out of 25 cannot be priced. Again, the five-factor model does a better job. Same conclusion. And then, finally, we see portfolios sorted by size and investment in table 7. And again, let's just look on the European sample here. We see for Europe, if we use the three-factor model, we see that 6 out of 25 portfolios cannot be priced correctly by the three-factor model, given European stocks. But using the five-factor model and the European sample, we see that all estimated alphas exhibit t-statistics that are below the critical value of 1.96 or larger than minus 1.96. So all these estimated alphas are statistically not different from 0, indicating that this five-factor model can indeed price equities in Europe correctly, sorted by size and investment, given the sample period. And this is also exactly what we have seen already in an earlier table in the GRS test. A GRS test is now a multivariate test that basically tests all of these guys together at the same time. And we have seen that the p-value was 0.4. Let's have a look once again. Yeah, you see here the corresponding t-test in this table, panel C, 25 portfolio sites sorted by size and investment, and you see Europe here, the GRS test is 1.02, the p-value is 0.45. This is exactly what we see in table 7, now broken down to all of these 25 estimated alphas here. So, the conclusion part you can go through at home. So, what else? Yeah, I think I gave you during the lecture, some tips for the exam already, some hints. Joulu on tulossa. Yeah. Joulu on tulossa. So, yeah. I was thinking about putting some of these lectures online so that you have the possibility to prepare better for the exam this time. It's still a playlist. I still have to upload the last 2 lectures, but so that you can go prepare for the lectures one more time. If some concepts maybe are unclear, if you go through it one more time, then you might have a better clue on things. So I will upload it and put it on my YouTube channel, and which is on my webpage from the university. And the purpose is not only, I will provide lectures there, and also I will also provide seminar presentations from myself and also from other people who present interesting papers, so that you can maybe get some ideas for your master thesis or whatever. Because I will, of course, provide the most recent research in finance, which is most likely be somehow related to what I do, but what I do is pretty, recent research in finance. So let's see how things are working out. But that's basically the help that I will offer you this term. And hopefully it will help you to prepare for the exam. Otherwise, if you have any questions for this lecture or in general, feel free to ask.
For the exam, you have other papers too. These are the main papers, the 5 ones, but you have some others there. Are those also expected to be read and understood completely?
No.
You might ask them.
No. I will only ask questions about what I spoke here in the lecture. I think that's a fair deal. So all tables that I didn't discuss here, I will not ask any questions. I skipped quite many tables here, so I think the number of tables that I could ask is pretty limited. But I might also ask some questions that are related to where I might try to investigate how much can you basically look outside the box. Yeah. Can you think critically? Can you draw conclusions? Can you merge like what is going on here in this paper with what has been reported in that paper? Is it congruent? Is there coherence, or is it basically contradicting? I can also ask comprehension questions, of course, because that's a university here. That's not an applied science school. So I can expect that you can think. Yeah. But of course, the first exam I will be fair enough. Some of the questions I asked every year the same. So I told you should ask. I also wrote it in the student guide. You should talk with people. You should talk with the other students that already made it. Then you can learn something. They will tell you. They will tell you what I will ask in the exam. But you have to speak with them. They don't bite. So, otherwise, in the first exam, I will definitely ask one question for this from the Stumbo paper. So I will at least one question will be that you test a hypothesis, about. I will grab one of the anomalies and then I will ask you, okay, make this hypothesis test. Then you have to make the test, and then you have to make a decision based upon the test. Is it in line with what they assume in their paper? Is it in line with overpricing? Is the outcome of this hypothesis test, is it in line with what you would expect if you really face overpricing, and if investor sentiment would be in partial explanation for cross-sectional asset pricing anomalies? So if I grab, for instance, momentum, it's not. It's not. All the three must be fulfilled, but we have already discussed in the lecture that for momentum it doesn't work out, because investor sentiment or changes in investor sentiment doesn't co-move with the payoffs of the momentum strategy. The momentum doesn't respond. So it's not an explanation for momentum payoffs. But for most of the others it is. So but if you just have read the paper and you just write down what is in the paper, it might be wrong if I ask something, if I grab one of the anomalies where it's not fulfilled. So that's why that's what I mean with critical thinking. If you read just the paper, you would think, yeah, well, investor sentiment is a partial explanation for asset pricing anomalies because they write so in the paper. But then you didn't get it, because if there are some anomalies where this is not fulfilled. So this is also what I want to see, that you understand what's going on here. Everybody can read a paper, everybody can do that, but not everybody can understand it. But that's why you are here, because I told you everything that you need to know. So, well, then good luck, and see you in the exercise.